Good evening and welcome to the Money Show, the show that puts your money first, front, and it keeps your money matters in the front and center. In a world full of financial noises, we are here to bring you clarity, confidence, and control over your personal finances, whether you are planning for retirement, building a portfolio, navigating debt, or just trying to make smarter money decisions. This is your space, your guide, and your weekly check-in with your wallet. Every evening, we bring you insights from top financial experts, decode the latest trends, and answer your burning questions on saving, investing, spending, and everything in between, because you're on the Money Show. We believe one thing: you don't have to be a finance expert to take charge of your money. You just need to get the right advice. And so let's begin the show, because we have experts on the show today who will be guiding on every aspect of your financial goal or investments. And if at all on this show you want to send across your questions, because we do your live financial planning as well, you can WhatsApp us your questions on our WhatsApp ID, which is 865-797-4571, our WhatsApp number. And you can also email us your queries on the moneyshow@etnow.tv. We'll just flash the WhatsApp number also on the screen so that you can note it down, and I will repeat it once again. It's 865-797-4571. That's the WhatsApp number. And the email ID that we have is the moneyshow@etnow.tv. All right. Okay, so let's continue. The RBI unanimously decided to keep the policy repo rate unchanged at 5.5%. Now, this move follows 3 rate cuts earlier this year, totaling a cumulative 100 basis point reduction. Now, this Central Bank also retained its neutral monetary stance. Now, on the growth and inflation outlook front, the RBI maintained its GDP growth forecast for 25-26 at 6.5%. Meanwhile, its inflation projection was revised downwards to approximately 3.1%, reflecting more benign price dynamics, policy rationale, and global context. The decision reflects a careful balance supporting domestic growth while managing inflation risk amid increased external uncertainties, including the impact of US tariff on Indian exports. Now, analysts termed this a dovish pause, noting that while rates remain steady, the RBI remains open to further action if warranted by evolving data. Now, what is the way for your investments? What about your loan strategies? Let's discuss all of this. I have with me Rahul Singh, CIO Equities, Tata Mutual Fund, Lakshmi Iyer, Group President, Investments and CEO, Bajaj Alts, Bajaj Finserv, Adil Shetty, CEO, co-founder, bankbazaar.com. Hi, good evening and welcome to the show, all three of you. Lakshmi, let's just get the gist of this policy from your end, because although it is a pause right now, talking about looking at the global uncertainties and the geopolitical factors also aligned with it, the inflation is in check, the GDP forecast is unchanged. What is the way ahead? In this entire cycle, we were anyways just looking for one rate cut. Do you think this pause is really justified?
Yeah, hi Kavita, good evening. So, if you break the year 2025 into 2 halves, we've actually seen in the first half itself, RBI gave a spectacular delivery of 100 basis points of rate cut, or I would say a century kind of a score. So it was but natural. I would say there was some front loading of the rate cut, which happened in the last policy. And therefore, it was intuitively natural to see a pause button. Of course, there was one school of thought which expected, given where we are on the macro scenario, to see a 25 basis point rate cut. However, our view is that, and if you read the text of the policy, it is going to continue to be nimble or fleet-footed, both from a liquidity perspective and from a rate perspective. So, the markets were largely contemplating about probably one more rate cut in the remainder of this calendar year. And therefore, that opportunity or that possibility to our mind still remains. Is it going to happen in the next policy or just after that in December? That would really, be a function of how the global macro is going to pan out.
Right. We'll be talking more on these lines because what investors really need to know is the tariff complication, and whichever way it sits in whichever scenario, whether India is not burdened or India is overburdened, what will happen to our bond yields and bond prices. But before that, let me get a take from Adil. So Adil, we were any which ways waiting for all the reduction to translate into our lower EMIs, but that has not happened completely yet. And now there is a pause, and then one more rate cut we will see whenever it happens. But having said that, so far can we say that the relief is also on a pause because banks are yet to translate or transfer the entire rate cut that has happened?
Thanks, Kavita. So even though we see a pause, right, like you rightly pointed out, the 1% cut which happened in the last 6 months, that benefit is now continuing to flow to users. So those who are on a repo rate loan already, repo rate linked home loan, your reset would have happened within a 3-month window. It could have happened immediately when the repo was cut, or within a 3-month window it would happen. For these people, right, 1% actually is a significant benefit. To give our viewers some context, right, on a 50 lakh 20-year loan, a 1% cut, if you keep your EMI same, is 37 lower EMI. So you've actually saved about 15 lakhs, 16 lakhs by this 1% rate cut, which is already flowed through. That being said, right, I think it's a time for home loan borrowers to be, I would say, vigilant. The reason I say that is first, the uh, uh, the average fresh loan cut, about 70% of the 1% has been passed. So one can expect that maybe rates will fall a little further. So if you look at, for example, public sector banks now, the home loan rates are between 7.3 and 7.5%. If you look at private sector banks, the rates are between 7.5% and 8%. It's a time to be open and vigilant to refinance options, because I know people out there, right, who are paying over 8% on their home loans currently, and now a window is starting to open where maybe you can refinance and also save yourself a lot of money.
Talking about refinancing strategy up ahead in the show, but then Rahul, now let's get the equity part in. So the announcement is as per what the street expected. We did see the market really not reacting well, but then it ended up flat on a muted note. But having said that, a lot of uncertainty as far as the tariffs are concerned, and even though the policy was on the expected lines, how are you looking at the market, especially keeping the tariff scenario in mind?
I think the key for equity markets now is how does growth pick up, and as usual, is it that the second half expectations are going to be again belied, and no growth comes in or no growth pickup comes in. So I think RBI has done enough. Just a bit on credit policy from an equity perspective. I think their statement also said that they have done enough for the growth to pick up. And I think from that point of view, a pause at least doesn't come as a complete surprise, although there was a part of the market which was expecting lower rates. So to that extent, I think what this does is, since it's kind of a hawkish kind of a pause, it helps the fact that the some of the earnings in the corporate sector, especially for banks, they don't go on a free fall, and the NIM pressure kind of bottoms out in quarter 2 for sure. And the second half, you will see an earnings growth rate there. And overall, I think we are beginning to see some green shoots in the consumption space. If you look at the recent results which have come out from especially in the FMCG space, which has not been doing well last 2 years. So if you look at it in combination, I think we have got a good mix of lower rates. Banking sector, which is the largest constituent of Nifty 50, their earnings kind of recovering from here on, consumption potentially recovering. And therefore, we are looking at a year where the earnings growth rate can be in the 10 to 12% kind of range, which is where I think the equity returns should also be. So our sense is that it is going to be a very steady kind of a year from an equity market perspective, and the credit policy has I don't think has done anything to alter that view. I think the biggest surprise can come from consumption if consumption does recover from here, because the rest of the consumption bases, whether you look at real estate, tourism, or cars or luxury cars, SUVs, that has not shown any sign of slowdown. So I think that consumption needs to shift to a wider basket, and then you will see a much bigger earning support. Having said that, I think valuations are expensive, so it's not that the market is going to run away from here, but it does provide a huge downside support to the market, in my view. The way the consumption recovery is taking shape slowly.
Rahul, since we're talking about the earning growth, I really want your comment on the earning season so far, the numbers that have come. A mixed bag, would you call it, or you would call it something on the expected lines already?
No, clearly a mixed bag, and with a little bit of a hint of a downside, in the sense that we have seen, I think, in Nifty 50 EPS, a 1% cut in the last 1.5 months of this results season, roughly speaking. So actually, there has been a cut in the Nifty EPS, because also there has been some one-offs. Some banking results have not been great because of the NPLs, which are all seasonal issues. Our own sense is that second quarter might not be very different, but third and fourth quarter, you will see some of these seasonal issues going away, consumption picking up. So as I said, overall, it has been a mixed bag with a little bit of a downside, not a huge one, but little bit of disappointment on the overall basis.
Sure. All right, Lakshmi, now let's talk about the tariff scenario. And I want you to help our viewers understand tariff scenario and its impact on inflation and our growth both ways. If we are really burdened with a huge number, or if we are able to negotiate, or get a middle ground here, we don't have that much of weight in terms of percentage, then what will be the scenario on the debt yields, on the yields and bond prices?
So, firstly, if you look at the way the tariff actually impacts growth, without getting into the math, we are talking about, and these are rough cut estimates, the number comes to roughly around 20 basis points where it can impact the overall growth. So if we are at, 6.8 or 7%, 20 basis points or 0.2% lower could be that much lower. So the thing is that in the larger scheme of things, is it going to be a material game changer? Maybe not. But what is bothering the market is this. That the near-term volatility that it creates because of the uncertainty, I think that is a bigger worry for the market right now. If you look at our inflation forecast, even in this policy today, we actually saw the FY 2026, which is the current year forecast, actually getting knocked lower. And the next year inflation, also the RBI has already given that number, which is higher than this year. So effectively, if you look at it and if you tie all this down from a rates perspective, the global uncertainty or the volatility resulting into a slowdown across the globe, including the US, is pro interest rates, which means that even if today we have seen a status quo, over the medium term, there is a propensity, and we have not yet seen US cut interest rates, mind you, which could happen probably in the next month or the month after. So this actually bodes well for interest rates with a little bit of a lag. Today, the market is still absorbing the fact that there has been no rate easing. Of course, bulk of the markets were not. So I think overall it can be positive for rates over the medium term, but the Agni Pariksha, as I call it, the bitter phase is what we are living through right now, which is going to remain slightly more volatile over the next couple of months till the tariff situation eases out, probably in our favor.
All right. So in this scenario, what kind of debt investment would you recommend? Can one go long as far as their debt investment strategies are concerned, or you would just prefer parking your money in any short-term avenue?
No, I think that, if you are being very, very short duration, I don't think that makes sense because there's hardly any yield available or rate available. So a good strategy would be to blend the two. If you see a dumbbell, when you're lifting weights, it's, plonked up at the two ends and the middle end of it is flat. So in our parlance, we call it the barbell strategy, where you buy a combination of the short and the long, and you have a reasonably moderate duration on your fixed income portfolio, and you live with it over the next maybe 6 to 8 quarters, and there could be potential gains on those front, given that there is no adverse materially adverse impact likely on the rates front.
All right. Adil, refinance option, once again, one should be considering?
Absolutely, Kavita, right? So we see this at Bank Bazaar. The home loan or the home is the biggest financial security that people take in their life. Now, the opportunity for refinance is because even today, as we speak, only 61% of people are on the repo linked loan. So 39% of people who are on MCLR base rate, they can definitely get a benefit of the good work the RBI has done with the external benchmark by shifting to a repo loan. So that's one aspect. Second, right, competition in banking has increased and the spreads on home loans have also come down. So today, the best home loans are available in that 7.5% kind of range. And that's quite an attractive rate. We've not seen that in the last 5 years. Now, when one shifts, right, they have two options. They can either choose to keep their EMI the same and reduce the tenor, which is the smart way to do things because that way you save a lot more money, or they can reduce their EMI and keep the same tenor. So what we're advising people, right, is definitely if you're not close to 7.5%, if you're significantly higher than 8%, look at the benefits. And just to put this in context, for a 50 lakh loan, 20-year home loan, if you refinance with a 1% saving and you keep your EMI steady, right, you're essentially saving 16 lakhs in the lifetime of the loan. You pay 37 lakh EMIs. That's a big deal. And if you choose to reduce your EMI and keep the same tenor, then your saving is half. So my advice to people, keep your eyes open. If there's opportunity, the best rates today are in that 7.5% to 8% range. If you do see 50 basis point saving, take it and keep your EMI the same and reduce your tenor to save the maximum amount of money.
All right, so I think the strategies are really sorted on the EMI front, on your fixed income as well as your equity strategies are concerned. But with that, it's a wrap on this particular segment. Thank you so much, all three of you, for taking your time out and helping our viewers with their investment strategies. Thank you. And time for a short break, but then post that, let's get your portfolio queries answered by Shweta Jain.